Of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap here on Friday, June 2nd, 2023. I am joined by my wonderful co-host, Jordan Youl with StoneCastle Investment Management. Thank you for joining me, Jordan.
Yeah, it's good to be here. Thanks for having me.
I always love I feel like Dad's away and the kids get to play when Bruce isn't around. I feel like we can get into some fun stuff.
Yeah, no, absolutely. Always look forward to joining you.
Not that Bruce isn't a barrel of laughs. Bruce, I didn't mean to hurt your feelings. Okay, listen, we have lots to talk about. Bruce and I talked a lot last week about the U.S. debt ceiling, and that all went through this week, so we're going to get into that. We're going to talk about risk on. You're going to tell us what is going on in the market. There's a bunch of different analysis that you've been looking at. You're going to explain all that to us. We're going to talk about growth versus value investing. We're going to explain what those are and what your thoughts are there. We're going to talk about potential early bull market leaders. This is exciting. I want to know more about this, Jordan. Of course, we're going to get into the U.S. debt ceiling that was approved. The default was averted at the 11th hour. And then, of course, we're going to get into some CSE issuer news. So let's start talking about risk on. What does that mean? And what are you seeing, Jordan?
Yeah, no, absolutely. You know, if we go back a couple of years ago, like off the COVID low in March of 2020, with all the stimulus thrown into the markets, we really started to see a shift, from fear to euphoria. A lot of the high beta, high growth names, especially in the small mid cap areas and the cyclical sectors, were really pushing the markets to all-time highs that effectively peaked in early 2022. And ever since that period, we've seen a rotation back into the larger cap, quality, lower beta defensive type sectors of the market. And that's been really in play up until the last number of weeks, really. So what I do is I review different sectors and different industry groups to try and get a pulse of the market to see what's working, what's trending, and any new trends that are starting to emerge. So I do have a chart of the cross asset analysis model, and effectively it's weight of the evidence. And when we're in a risk off regime, which has been in place since 2020 of January, we tend to see a flight to safety, so strength in the US dollar. And then from a market capitalization perspective, we tend to see leadership in the large caps and the small mid caps lag on a comparative basis. And because small mid caps are out of favor, market breadth is quite narrow and weak. And we see this every 18 months to 24 months. If you look at the chart on the very far right-hand side, despite the different macro narratives and themes out there, the model is no different, right? So if you go back to 2011, 2013, 15, 18, and 2020, we were dealing with the European debt crisis, China hard landing, the Fed in Q4 of 2018, COVID most recently in 2020, and the current narratives today. But if we take a look at the money flow, the next signal is a risk on positive signal. So you can see the histogram in the second panel is just slightly below that zero line. So if it gets above that zero line, that is a mechanical buy signal, just validating the fact that investor sentiment is improving and there is money flow and accumulation back into the high beta torquier names that we haven't really, had much interest in over the last 2 years.
There's been some fairly, for where we're at from, the economic standpoint, there has been some good indicators, it seems, over our conversations over the past few months. So it does seem like there's a lot of stuff going on with debt ceilings and with inflation and with raising rates, but seems like there is some good data that seems to be coming out of it. Is that correct?
Yeah, no, absolutely. The LEI index, which is from the conference board, it's been declining, but that rate of change is starting to flatten out and improve. And that's a weight of the evidence. There's 10 components, 3 financial, 7 non-financial variables and factors that go into it. They're coming out in a few weeks, but effectively we want to take a look at that LEI index because it is a leading economic indicator for the economic backdrop. And the S&P 500 is actually a component of that particular benchmark in itself. So as long as the S&P 500 continues to chug along, we can expect that the economic backdrop to improve as well.
Very, very interesting. Okay, let's talk about growth versus value. Now, for most people, they might know this, but these are two different approaches on how you invest.
Mm.
Value stocks are typically companies that investors think are undervalued by the market. And so they think that there's some potential for upside there. And growth stocks are companies that investors think will deliver better than average returns. So it's just two ways that in your due diligence process at picking a stock that you intend to invest in. What is going on with growth versus value right now? What are you seeing? Which side of the coin would you be on?
For moving forward, growth, I'd focus on growth over value. So this is a relative rotation graph. We've used this technical tool many times on the program. There's 4 quadrants. There's leading, weakening, lagging, and improving. And we tend to see the constituents move in a clockwise rotation. And this is really significant because this is like anticipation of, emerging trends that are taking place. So what we've done here is we've compared the high beta versus low volatility ratio. That's moving in a positive direction, along with IWM, which represents the Russell 2000. That's an ETF. It's moving in a positive direction in the lagging quadrant, and the growth versus value ratio again is moving in a northern direction, and all 3 constituents are actually on the cusp of rotating back into the improving quadrant. And we really haven't seen this trend. Well, the last time we saw this was effectively in June of 2020. So what we're seeing is momentum and buying power coming back into the torquier growth areas of the market that have been really under-owned, very lack of interest for quite some time. And, these trends tend to last for multiple quarters. So if you're an investor and you have a tremendous amount of cash on the sidelines and you're looking for opportunities to, put capital to work, this is an area of focus that, we're doing at the portfolio level right now.
In these times of high inflation and raising interest rates and debt ceiling issues, is there certain sectors that you and Bruce tend to look at more than others? I know that there's certain sectors that tend to do better based on what's going on, from an economic standpoint.
Yeah, absolutely. And I brought another chart here, just kind of telegraphing the different stages of the economic cycle. So going back to that value versus growth question, going back to 2022, you can see in the chart that, energy, consumer staples, U.S. healthcare, in particular, the defensive proxies really outperformed other sectors. So we were in a very risk-off market environment in 2022. So those particular sectors really thrived and did well. Whereas on the flip side, the communication services, technology, and discretionary really lagged and struggled on a comparative basis. But you can see on the chart, early bull market, when we bottomed in October, those 4 sectors on the very left-hand side in the green box tend to lead the markets higher. And this is kind of coincides with that relative rotation graph and that first chart I referenced at the top of the call with that cross asset analysis model that's on the cusp of turning positive for the first time since 2020. So we're seeing a big shift internally that's driving the markets higher. And this is really what we want to see from a leadership perspective as we're attempting to take out previous highs at the index level.
Amazing. Okay. Early bulls. This is a good Friday, Jordan. Early bull market leaders. What are you seeing?
Yeah, so the early bull market leaders, again, that kind of coincides with the big sector rotation we're seeing on a relative basis. The defensive proxies were the leaders last year. Now we're starting to see a recycling back into the offensive sectors that really led the markets off the COVID lows in 2020. But they peaked really in the midpoint of 2021. And despite the markets inevitably hitting all-time highs in early 2022, in the midpoint in 2021, we started to see a big rotation out of growth into large cap value. And like I mentioned, that's really been in play from an opportunity perspective up until just recently. So we're getting, new swing highs, new breakouts across many industry groups. So, just as an example, this morning when I was scanning the 104 industry groups that represent the entire stock market, 11 of them broke out to new highs and new swing highs. Autos, some financials, REITs, insurance companies, technology, software, you name it. So we're starting to see market breadth, which has been a real problem over the last multiple quarters. The takeaway here is market breadth is starting to broaden out. It's not as narrow as it was in Q1. We're starting to see other industry groups and sectors starting to participate as the markets are breaking out right now.
Interesting stuff. We'll see what happens. I guess, what are your thoughts as far as some of these leading indicators and kind of some of the early signs that you're seeing? I mean, there's that old adage that sell may go away. Do you think that we'll kind of revisit this in the fall, or do you think that we'll see this occur over the summer? Has that mentality kind of shifted as we've come out of the pandemic?
From a seasonality perspective, that old adage or saying sell and may go away has not been as consistent over the summer months. I can provide that chart for any viewers that are interested, but effectively the S&P 500 and the TSX has actually generated pretty strong positive returns over June-July timeframe. Where it's a little bit more consistent from a seasonality perspective is, September and the first 2 weeks of October tend to be more volatile, and we tend to see weakness over a several week period as we go into Q4 and have that year end rally. So there is that window. Is it 100% accurate? No, it's not, but you can chalk it up as being a little bit more consistent from a seasonality perspective in September and October. But from here on, between now and then, we're seeing a tremendous amount of opportunities at the benchmark level, but there's also other industry groups and sectors that thrive and do well, like even the miners, for example. They tend to perform quite well in the summer too. So it really depends on, as an investor, what your objective and interest is, because regardless of the seasonality or where we're at in the economic cycle, there's always opportunities to generate return in this environment.
Absolutely. I know the miners are busy getting their summer work programs going and getting them started. That's always exciting to watch that happen and see what's going to come from that. Okay, let's talk about the big news of the week that we were all anticipating, is that the Biden's U.S. debt ceiling, it was increased, and was that Tuesday that they finalized that?
It was Wednesday. It's going to his desk today to sign, and he's going to speak to the American people and the world effectively today.
Right? We all listen.
Yeah, everyone's watching. It's a bipartisan vote. Both parties didn't really get what they wanted, but the alternative, like defaulting, would have been much more severe and catastrophic, as you and Bruce mentioned last week. So, as a result, the market's responding quite favorably. Last time I looked, the markets are at an intraday high right now. All sectors are up, but it was definitely an overhang this week for investors. We wanted to make sure that the U.S. Passed this bipartisan bill before Monday, really, and they got the deal done.
Chaos would have been if they didn't approve that. I think that there would have been some chaos across the border. I asked this to Bruce last week, and I'm just curious your thoughts. This is a 24-month increase in the ceiling. That seems so short to me. I mean, it's hard to believe that they can implement this and in 24 months be able to bring it back down to to its original state. What are your thoughts on that?
Yeah, it kind of pushes it down the road a little bit, but it's in relatively short order. But what is interesting is we are going to have another presidential election between now and then as well. So we'll see what the results are of the election. But it's going to be top of mind again for investors. The U.S. cannot afford to default. It never has. So they have to be creative with spending cuts and other variables to make it work. But ultimately the U.S. cannot afford to default because it would create a ripple effect across the globe. It's not just a domestic issue.
Oh yeah, it's a big deal. Okay, you had some jobs data that you were going to talk about. What's going on there?
Yeah, so the job numbers came out this morning and they were well above consensus. Analysts were expecting 190,000 jobs for May. There was actually 339,000 created, which was great. The economic backdrop in the labor market is still quite strong. But what was really interesting is, and this came out this morning, was the unemployment rate actually ticked up a few spots. It was 3.4% previously. They were expecting 3.5, and it actually went up to 3.7. Now, over a long term or since inception, we're still well below the historical average. So we're not overly concerned with the unemployment rate going up slightly. But just as a leading economic indicator and something to keep our eye on is just tracking the number of hours work per week. And so through the Fred data, this is actually a component of that Conference Board LEI index that I referenced earlier. It's actually one of the components and variables. And despite, the most employees remain employed, many of them are actually starting to work less hours per week. So if that tends to continue to trend in a negative direction, we could see the unemployment rate tick up further. And historically, anytime we start to see the unemployment rate go up, that tends to act as a strong precursor that a recession is imminent. I know recession is on a lot of investors' minds right now. The question is it going to be like a soft landing or a hard landing? So, employers tend to reduce their employees' hours before they do mass layoffs. So this trend peaked in 2021 and it's been declining ever since. So it's just something that we want to keep our eye on for sure.
I mean, the job market has drastically shifted since the pandemic. More people working for themselves. In British Columbia, we're seeing another minimum wage increase. So, it feels like there's a lot of turning tides in the job markets, I think, around the world after the pandemic, and it'll probably take a few years to shake out and feel some kind of normalcy of what we might see in various economic cycles. But it'll be interesting to watch and see what happens there. Let's move to my favorite part of the show, which is the CSE issuer news. I want to talk this week about TRUL. TRUL is one of the CSE's wonderful, glorious, vertically integrated U.S. MSOs. They are currently in 11 states, I believe. We love you, TRUL. They're an amazing company. Kim, their CEO, is an incredible lady, and love talking about them. But they came out with a press release this week just talking about the fact that in Florida, in the state of Florida, there has been over 965,000 signatures that have been filed for the Smart and Safe campaign. This is more than enough. It represents more signatures than they require to secure a ballot placement for the 2024 general election, which will, if it goes through, allow Florida to become a recreational state. Now, this is very, very big news. We haven't talked about U.S. cannabis as much. It just hasn't. There hasn't been a lot going on in the U.S. cannabis space for a little while. And I know that you and Bruce spent a lot of time doing your due diligence on U.S. cannabis. You guys have a cannabis fund. So to me, I think I've heard this before. I don't know if this is completely accurate, but Florida, should it go recreational, will be one of the largest economies in the cannabis space in the U.S. So this would be a huge deal. There's also a lot of the cannabis companies, U.S. cannabis companies listed on the CSE that are in multi-state, so multi-state operators, and they I think have been doing the legwork in Florida for quite some time, if I'm not mistaken. So there's a lot of them and private companies that are primed and ready to go should this go through. Do you think that if Florida, I guess my first question is, do you think that this will go through? And my second question is, do you think if Florida does go through, just based on the size and scope of the economy there for the cannabis space, will this be a driver to finally kind of push things through in the U.S. on a federal level?
Yeah, I believe so, without question. You mentioned a lot of catalysts that can definitely move the needle, not only for TRUL, but the multi-state operators and the sector in particular, right? The MSOs have been hit really hard, not so much from a fundamental perspective or from an operating perspective, but just because of investor sentiment and the type of market we've been in the last 22 months. But, if this risk on narrative plays out and we continue to see some follow through, this is definitely a sector that's going to garner a lot of interest from investors because there's tremendous value there. But based on the news on this particular issuer, yeah, it's going to create a significant opportunity for Florida and these MSOs, and from a revenue perspective and just from a target target market and population perspective as well. Like Florida is massive. So without question, it's a big catalyst for the particular company, but also more important, I think, the sector in itself.
It for some reason feels surprising Florida isn't recreational yet, but it would be huge. And I know, it was several years ago now. You might remember some of these talks where you go in and into various forums, whether they're conferences, and these multi-state operators really started kind of building out this strategy with the idea that one day, and this is years in the making. Some of these companies have been building out operations, state by state, building out relationships and partnerships in states that aren't yet legal. I mean, this is an incredibly long play, and it's very complicated. They have operations in various states that all have different regulations. Each state has its own, and it'll be quite, I think, the scene. I mean, if this does go through on a federal level, it'll be quite the scene, and it's quite impressive, these companies that have implemented this very long-term risky strategy. But this would be amazing if it did go through. Are you guys still bullish on the U.S. cannabis space? Is it still something you guys look at actively?
We're always looking at it actively. We have a little bit of exposure. We've reduced our exposure in the space over the last 2 years. But if the SAFE Act gets approved and if the companies improve from a technical and fundamental perspective in our modeling, we have no problem adding a full position back into the cannabis sector. We've been in and out of this sector many times since 2013. So we know the sector very well, but there's a lot of catalysts that can effectively move the needle and get the share prices much higher than they are today. So yeah, it's definitely on our watch list, and we track the MSOS ETF, which is a good bellwether to track the MSOs. And, it's gone sideways, right? It's been in a consolidation pattern for quite some time, but we're starting to see positive momentum divergence. And what that means is it's just really telling us that the distribution and the selling pressure on that particular ETF has subsided. We're not seeing as much selling pressure on the MSOs as we did over the last 18 to 22 months. So that just really tells us that there's not as many sellers left, and we're going to start to see some buying power coming back into the area. But yeah, any type of announcement could be a catalyst that can move the stocks significantly higher. And last time we saw that was in the midterm elections in November. And we all anticipated that the SAFE Act was going to get approved by year end, but it got delayed, right? And we started to see more distribution selling off in that sector in the first 2 weeks of December. So yeah, we really like the sector long term, right?
Yeah.
If you're beyond 12 months, 24 months, we think it's a great entry point, but you got to be able to stomach the volatility and some potential delays, because there's things that still need to be worked out before we can see the stocks really move much higher than they are right now.
Yeah, absolutely. Listen, at the CSE, we've gotten to have a front row seat to the cannabis space and the U.S. cannabis space, which is fairly unique opportunity to be front row seats to this massive movement that's happening in the U.S. and just their massive marketplace. So it's definitely been amazing to watch from our perspective. Congratulations, truly. I hope this all goes through, and for, I'm sure, all the effort that they put in, for this to continue to grow. Jordan, what are we going to think about going into next week, other than it's a gorgeous weekend?
Yeah, no, absolutely. I'm looking forward to the weekend for sure. But I want to see some follow through. So, this week, market breadth is broadened out, which is fantastic. And the small caps have outperformed the large caps, which is fantastic. So I'd like to see that carry on into next year and continue to move upward and onward, because that definitely helps lift, the market and also improve investor sentiment. So that's very bullish and constructive. In the upcoming weeks, though, like on the 9th, we have the Conference Board Employment Tracking Index. They're going to report. So kind of goes back to my comments earlier on the unemployment rate. We want to see what direction that takes us. And then on the 14th, we do have the FOMC coming out, and we've seen a pretty big shift, between the market anticipating the Fed hiking 25 basis points to holding to hiking again. But, one of the Fed members this week said that we don't have to consecutively, hike in every meeting. So we could pause and then hike, maybe in July. So the market anticipated or read that as, there's a high probability that they may hold for the June meeting. And that could definitely come to fruition. And as a result, we're starting to see technology growth and investors starting to become more bullish on the equity markets if the Fed does decide to pause.
I think we're on interest rate hike fatigue. Climbing up that mountain. We're tired. We need a break, Jordan.
Yeah,
We need a
exactly.
break.
Yeah.
Well, listen, I always enjoy our time together on Friday afternoons. I hope everyone has a wonderful weekend. It's always a pleasure to chat with you, Jordan. Thank you so much.
Yeah, thanks for having me.